Hi, I'm Adrian. Welcome back to Premium Logic Lab. Last night, the S&P 500 sold off. The Nasdaq dropped more than 1.4%. And if you've been watching the commentary, you've probably heard a lot of explanations. Some are blaming AI, some are blaming valuations, some are saying this is the start of something bigger. Today, I want to slow this down. Because when markets drop like this, the most popular explanations are rarely the most useful ones. So instead of asking, why did the market fall? I want to ask a better question. What kind of sell-off was this? Because not all sell-offs mean the same thing. Let's start with what most people are saying. The dominant narrative today is that investors are suddenly worried about AI disrupting software margins, that competitive pressure is increasing, and that parts of the market were priced for perfection. There's some truth there. Certain software and analytics names were hit hard, and when leadership cracks, the Nasdaq feels it quickly. But that explanation alone doesn't explain the structure of the move. A 1.4% Nasdaq drop isn't just a change in opinion. It's usually a positioning event. That's the first thing to understand. Markets don't move that much because everyone suddenly agrees on a new story. They move that much when positioning has to adjust. This is where most commentary misses the point. Narratives explain why people feel uncomfortable. Positioning explains why prices move fast. And this sell-off had all the characteristics of a de-risking move. Volatility picked up, correlation increased, and selling spread across tech broadly, not just one or two names. That tells you this wasn't just stock picking, it was exposure reduction. So, what was the real pressure point? In my view, it wasn't AI is bad or earnings are collapsing. It was uncertainty around future margins in a market that was already heavily positioned toward growth, software, and technology leadership. When expectations are high, even small doubts matter. Not because they're catastrophic, but because they force investors to reassess how much risk they're carrying. And that's the second key idea. This wasn't about forecasting the future. It was about managing risk in the present. Professional money doesn't wait to see if a narrative is fully true. It adjusts exposure when the distribution of outcomes widens. And that's exactly what happened. Like you can see this in how the sell-off unfolded. It wasn't chaotic. It wasn't indiscriminate panic. It was methodical. That's not what markets look like at the start of a crisis. That's what they look like when participants are saying, I'm less certain than I was yesterday. Now let's address the big question everyone is really asking. Does this mean something is broken? At this stage, there's no clear evidence of that. We didn't see stress in credit markets. We didn't see liquidity disappear. We didn't see forced liquidation across asset classes. What we saw was leadership weakness and risk trimming. That distinction matters. Because many traders make the same mistake here. They see a sharp down day and immediately jump to conclusions. Either this is nothing or this is the beginning of the end. Both are emotional responses. A probabilistic thinker does something different. They ask, what scenarios does this open up? One scenario is that this is a healthy reset. A market that was leaning too hard in one direction rebalances. Another scenario is that this becomes a longer period of consolidation where volatility stays elevated and leadership rotates. And yes, a third scenario is that this is the early phase of a deeper drawdown. But that scenario requires confirmation, not imagination. This is why reacting emotionally to single-day moves is so dangerous. Markets are processes, not events. And this brings us back to the bigger lesson. The most important skill in trading and investing is not prediction, it's interpretation. Understanding whether a move is driven by liquidity, leverage, positioning, or fundamentals. Because each one implies a very different response. If you mistake a positioning unwind for a fundamental collapse, you'll panic when you shouldn't. If you mistake a structural problem for a routine pullback, you'll take risks you shouldn't. Right now, the evidence points toward a market-adjusting risk, not a market-breaking. That doesn't mean prices must bounce. It doesn't mean volatility is over. It means context matters more than headlines. And this is exactly why we've been building the foundations in this channel. Probability over certainty, risk over prediction, process over emotion. In the next video, I'll connect this sell-off back to options specifically. How changes in volatility and expectations reshape opportunity, and why most traders misread what volatility actually represents. That's where we'll continue. Thanks for being here.